Hello and welcome to the course US Mortgage Learn A to Z of the mortgage lifecycle. Let me introduce myself. I'm a mobile app entrepreneur for my own apps, and at the same time, I'm a product consultant for two enterprise apps in the US based energy utility company. I have total 20 years of experience in the IT industry as a business analyst, product owner, program manager for various US mortgage related IT products. I have extensively worked in this field for more than 10 years in terms of coaching, gathering the requirements for these mortgage related products. That's about me. Let's quickly learn the evolution of the US mortgage industry. Let's first quickly understand what is mortgage. Mortgages are the loans given to the consumers for the purpose of the purchase, construction, or repair of the real estate. Mortgages were started in the year of 1930 by insurance companies in the US primarily with the hope of gaining ownership of the properties if the borrower failed to make the repayment on it. It wasn't until 1934 that the mortgages in their current form came into being. The Federal Housing Administration (FHA) played a critical role in this process. One of the factors underlying the American dream consists of purchasing and officially owning a house. Only a slim margin of the middle class can outwardly afford to purchase a home without applying for a mortgage to achieve what may pursue to make a reality. The mortgage market has evolved with the ever-changing phase of the real estate. The mortgage industry or the history in the United States have been fraught with the booms and the busts that have enriched and devastated families affected by the recessions and the depressions. Nevertheless, mortgages remain as the primary form of lending when it comes to property transactions. The mortgage process entails the granting of monies to obtain a home with the good faith that the debtor will repay the loan with the interest attached to the life of it. Both the debtor and the lender benefit if nothing goes crooked. The US mortgage industry is one of the world's largest. The total value of the mortgage debt outstanding in the year 2017 was around $13.5 trillion. The fact that most of the citizens cannot afford to buy their dream home outright has given this industry its mammoth size and the stature. As buying a home is one of the most prominent goals in everybody's life, applying for a mortgage becomes an integral part of the process. To ensure that every citizen's endeavor of owning a house is successful, the government has taken several steps to abridge the process. However, over the course of its evolution, the industry has not just grown in size but also in complexity. Here are some of the vital turning points in its history. The beginning. It all began in the year 1929 when the nation was hit by a severe economic depression. As the financial sector of the country turned into chaos, very few citizens could afford to own a house. As the depression reached its peak, most financial institutions began to wind up from the market. The Great Depression was the worst economic downturn in the history of the industrialized world, lasting from 1929 to 1939. It began after the stock market crash of October 1929, which sent Wall Street into a panic and wiped out millions of investors. Over the next several years, consumer spending and investment dropped, causing steep declines in the industrial output and employment as failing companies laid off workers. By 1933, when the Great Depression reached its lowest point, some 15 million Americans were unemployed and nearly half of the country's banks had failed. While mortgage industry existed even before the Depression, only the short-term loans were available. The duration was not more than 5 years, and the loans offered were on the interest-only basis. The principal remained due on the borrower and had to be repaid at the end. In case the borrower was unable to repay the loan amount, the property was foreclosed. As the economy lay in terrible channels and with the financial condition of the citizens deteriorating, the number of foreclosures surged to a new height. To bring an end to the situation, the government intervened by inventing the long-term mortgage. which was conceptually modern. This was the beginning of the self-amortizing mortgage in order to counter the effect of the depression on the housing industry. Federal Housing Administration (FHA) was also instituted by the federal government. It was a prominent step in the initiation of the mortgage industry. FHA started offering the guarantees to the banks and the financial institutions and minimized the risk against the defaults from the borrowers. The financial protection ensured a new optimism among the lending institution, and the industry began to grow slowly. Alright, let's take a look at the next level of the changes which happened in the history of the mortgage. It is called period of consolidation. In 1938, the economy was still finding it difficult to come to terms with the financial crisis. Many financial institutions did not feel totally secure to offer long-term mortgage as they believed it wasn't safe to commit huge funds into an asset that lasted for so long. This situation demanded an institution that could buy the mortgages from the banks in order to free their capital. This money could again be available for the banks to grant new mortgages. The government responded by creating the Federal National Mortgage Association, which is also called as Fannie Mae, which ensured liquidity in the mortgage market. This paved the way for the majority of the citizens with a limited income to realize their dream of buying a home. The incorporation of Fannie Mae allowed lending institutions to charge low interest from the borrowers. Moreover, it also balanced the demand and supply of the mortgage across the country. In the year 1968, the Vietnam War caused a huge drain on various types of resources. This also led to a huge liquidity as well as credibility crisis in the mortgage market, which impacted the government's balance sheet. Fannie Mae was called upon to reduce the lack of liquidity, for which it had to borrow funds at a high rate. It increased both the government's and the Fannie Mae's debt. President Lyndon Johnson administration had to recharter the institution into a private company that allowed its stock to be traded to private stakeholders and capital investors. As Fannie Mae still maintained a public mission issued by the government, it became the first government-sponsored enterprise, GSE. Simultaneously, a new corporation known as the Government National Mortgage Association, which is also called Ginnie Mae, was also established at the same time. It started to insure FHA loans apart from initiating the other government lending programs. Furthermore, the Fannie Mae's monopoly was compensated by a second GSE known as the Federal Home Loan Mortgage Corporation, which is called as Freddie Mac. Alright, so let's look at the present situation. So, in the year 2008, the subprime mortgage crisis in the US triggered a global recession. Few of the most prominent financial institutions in the country filed for the bankruptcy, and the mortgage industry faced one of the biggest crises in its history. Owing to these unwarranted events, the federal government has initiated a massive restructuring process. Various regulatory practices have already been initiated to avoid the predatory lending, which led to the crisis. Citizens are being educated on the implications of the hybrid and adjustable rate mortgages so that they can avoid the pitfall when fixed rate loans expire. The industry has now been brought under the control through the stringent regulations, which are being strictly followed by all the parties involved. As the better practices become the norm, the US mortgage industry is slowly regaining its stability and is bound to get much more robust over the coming years. So these are the different topics which you're going to learn in this US mortgage course. You would be learning about mortgage fundamentals, mortgage, how the mortgage is produced, and what are the different players and how the mortgage is serviced. And once the mortgage is, while it is serviced, so how it is being sold in the secondary markets. You would be learning all these in this mortgage banking, the course. All right, so the next one is what are the key takeaways? Who has to learn the US mortgage? Someone who wants to know how the housing loans are originated and finally sold in the secondary market, understand the complete life cycle of the mortgage. Someone who wants to pursue their career as a business analyst, product owner, project manager of any information technology products which are built around the US mortgage domain. The course can be taken as a basic course for entry-level lenders, independent mortgage bankers, and companies with the staff serving the mortgage industry. If you want to learn about the mortgage but cannot pay for a hefty fee for the certification from the renowned institutions like MBA, this is an option to go for. This is all about the introduction of the course. Thank you for listening to this, and I will see you inside the course. Thank you.